Hi all, it's only me, just taking you through video recording of the exam that we did on Friday, the sample one. I did do it this morning and I was recording it, but it turns out that it didn't record the sound, which I expected as I was going along, so we'll do it now. And I'll go through what I went through this morning. So the first question was, it says a company has assets of 55,500 and liabilities of 37,845. And the company, so the equity of the company is. So as I've said when we do this question, is that we always write down the accounting equation, okay? So the accounting equation is assets minus liabilities equals capital. And then all we did is we supplement the numbers. So the assets, I didn't want to do that, did I? So the assets, 55,500, we've got that figure there. Liabilities, 37,845, we've got that there. So therefore, as a process of elimination, we can actually work out what the actual capital is, okay? And that's what we've done for that one. So the answer to A, so the answer to question 1 is B, 17,655. Next thing we did is question 2, is where we looked at which of the following two items should be recorded on the debit side of the trial balance, okay? So we went through them, and when we discussed it in class, we talked about pearls, okay? So we debit, so we debit purchases, that's a P, expenses and assets, so they're on the debit side. And on the credit side, we've got revenue, which is income from our sales, so on and so forth. Then we've got liabilities, and we've also got shareholders' funds, otherwise known as capital. Excuse me. Just as a reminder, what we've said in the past, that assets are things that we own, and liabilities are when we owe. So assets, things that we own, tend to be things like motor vehicles, or buildings, or computers. They're what we call long-term assets, or non-current assets. We buy for the long term. But we've also got current assets, as they're called, which is things like stock or money in the bank or things like that. So they're called assets. As far as liabilities are concerned, liabilities, as we said, are things where we owe. So we owe what we call non-current liabilities. So they're long-term loans or long-term liabilities. So they're things like bank loans, and they're things like mortgages. So things for the long term. Other liabilities tend to be our suppliers. So our suppliers are trade payables, as they call. They're because we owe them money. And we usually get VATs as a current liability as well. So short-term liabilities. Okay, so as far as this question is concerned, it said the following two items will be recorded on the debit side of the trial balance. So which two will be on the debit side of the trial balance? So in other words, this side of the trial balance. So bank overdraft, as I've written there, bank overdraft is a liability. So that's not on the debit side, it's that one there. We've then got purchases, as we've identified. So purchases are on our debit side. So that one is correct. And then we've got sales tax payable. So that's tax on our sales, but it says payable, meaning we've still got to pay it. So anything payable is a liability. So that's a liability. And then we've got trade payables, which are our suppliers. And again, they're liabilities, as you can see. Okay? And then the final one is sales returns. So these are sales, which was income, but they've returned it. So it goes back in to our assets. It goes back into our stock because they've recorded it. So therefore, that will be a debit. Okay? We will go through them in class if need be, just so that you understand it. So again, we've done this one a few times in class. So this is called stock valuation. So stock, closing stock, goes in two of the financial statements. It goes into the cost of sales in the profit loss account, and it also goes as an asset or a current asset in the balance sheet. Okay, so what we do here is we have to value the stock using what we call the FIFO method, or first in, first out. That basically means that the stock that comes in first is the stock that goes out first. So with this story of this is in January, we've got opening stock to the value, well basically 70, we bought stock again. So we've got opening stock, and we've got 70 units that cost us £19, okay? Let's rub that out so you can see. Excuse me. So in January, we've got 70 units that are £19 each. So therefore, we've got, as you can see here, we've got 70 units at £19 is £1,330. In February, we bought some more stock, so 50 units at £22 each. So therefore, that gives us £1,100 is the cost of that stock. So at the end of February, we've got 120 units, so 70 and 50, at a total cost of 2,430. Okay? And then in March, what we've done, we've got sales of 40 units, and we've sold them at £40 each. The £40 each is the selling price. We want to know what was the cost, because we're after the closing inventory, so what's the value? So January and February stock coming in, and in March it stopped going out, okay? So therefore, those 40 units, the stock that came in first is this one, okay? So the stock that came in first is this one in January. The stock that came in second is the one in February. So therefore, when we look at first in, first out, we use that figure because that was the cost of the stock that came in first. We don't do LIFO anymore, but if we did, the stock that came in last would be that one. So we would issue out the 40 units at £22 if that was the case. But because we're doing first in, first out, this was the stock that came in first. So we're going to use 40 of the 70, okay? Excuse me. So 40 times 19 is £760. So that's what it cost us for that issue, as they say. So what we do is we basically take off the £760 from the stock that we've got, which gives us a closing stock figure of 1,670. So a closing stock figure of 1,670. And we had 120 units, but we sold 40 of them, meaning that we've got 80 left. Okay, so that's first in, first out. Question 4, it says the type or branch of accounting that generates reports for the use for external parties and creditors. We tend to focus on maybe two types of accounts. We do financial accounts and we do management accounts. Taxation is a separate matter, but for our purposes, what the financial accountants do is they produce the financial statements for external users, okay? So external users are people like, external users are people, as it says here, so people like creditors. So if you're going to borrow some money from the bank, you would want to see your financial statements that the financial accountants have put together. Investors, so if you're going to invest in the company, again, you'd want to have an idea as to what your return is going to be. So you look at their accounts, and then government agencies or people like the HMRC, okay? Her Majesty's Revenue and Customs. So financial accountants are those that basically produce the accounts. Excuse me. Financial accountants are those that produce the accounts for external users. Not that it's in the exam question, but for internal use, it tends to be management accountant. So I would like to see, as a management accountant, I would like to see 3 or 4 years of financial accounts so we can start making decisions and work out what happened, okay? So the answer to that question, is accounts for external users is financial accounts. So financial accounting. The next one says wages paid to labourers working in the manufacturing department is treated as, okay, so wages are an expense, but I'll just explain the others. Obviously it's not an asset because an asset is something that we own, and it's also not a liability because we've paid them, okay. It's not income because that's money coming in. So in this example, as I just said, it's basically the answer to this question is an expense. So wages is an expense. The next one says the balance sheet is sometimes referred to. So the balance sheet is otherwise known as the statement of financial position. Okay, so the statement of financial position. I'll go through this one again because this one was an interesting one that we did in class, so I'll explain to you. I don't need to rub it out. I'll just explain as we're going along. So this one said a company bought a machine on the 1st of October in year 1 for £34,000. The machine had a useful life or an expected use of 8 years, so it means that would be the length of the asset, how long it would last for before it becomes knackered. So like buying the asset for 34 grand and after 8 years it won't be worth anything. But what it does say is at the end of the useful life with residual value of £2,000. So if I liken this to like a van, so if I buy a brand new van for my building firm and it costs me £34,000, okay, and every year I'm putting rubbish in, then what HMRC allow us to do is to work out like a depreciation charge, as it's called, and the depreciation charge is for the wearing out of the asset. So again, so if I buy that van for 34 grand, in that first year I'm going to be throwing bricks in it and loads of rubbish. So because of wear and tear, they allow me to reduce the value, and that depreciation charge, as it's called, goes in the profit loss account. So it goes in the profit loss account as an expense. Okay, so this question says, so they bought it for 34,000. Excuse me. Cough. So we bought it for £34,000. At the end of the 8 years, we've got residual value, means we can sell it for £2,000. And the years that we've got it for, how is the useful life of the asset, is 8 years. So what you do is 34,000 minus 2 gives you 32,000. Divide that by 8, it means that the depreciation charge is £4,000. Yep. So in other words, at the end of the first year, that van that cost us £34,000, at the end of the first year, it would be worth £30,000. So we take off £4,000 each year. Again, for this question, it says, which is what I've done up here, it says so it's bought on the 1st of October in year 1. On the 31st of March in year 6, the machine sold for £28,000. Okay? So they sold it for £28,000 in year 6. It says the company's year end is the 31st of December, and they're using what they call a straight line method of depreciation. It charges a full year's depreciation in the year of purchase and none in the year of sale. All that means is, so when we bought it on the 1st of October in year 1, which is here, bearing in mind our year end is the 31st of December, we've only had it 3 months at that point, but we still charge a full year's depreciation of £4,000. Okay, so year 1, year 2, year 3, year 4, and year 5. When it comes to year 6, excuse me, we sold it on the 31st of March in year 6, so 31st of the 3rd. So it says that in the year of disposal, you don't charge any depreciation in year 6. So we've got year 1, 2, 3, 4, and 5. So therefore, we've got £4,000 every year, multiplied by the 5 years is £20,000. Okay, so therefore, this is called our cumulative depreciation. So we've got, so over the year, so £20,000 is our cumulative depreciation. So therefore, we've got this little calculation here. That's all. Just show you this bit here. So therefore, what we're saying is the asset that cost us £34,000, but it's reduced in value over 5 years by £20,000, which is the depreciation, i.e. the wear and tear, means that the value of the asset, oops, let's go back. Come on. Sorry, it's gone skew with. Let's do it again. That's where it was. Here, wasn't it? Yeah. So therefore, what we're saying, he says, is that the asset, so it's reduced in value. Oh, that's where I was up to. Sorry about that. So here, So £34,000 was the cost. We've depreciated it by 20,000. That's the wear and tear, meaning that the value of the asset at the end of 5 years is £14,000. That's the value of the asset after 5 years. Okay. We then sell it for £28,000. It said the machine was sold for £28,000, and we need to work out the profit or loss on disposal. So therefore, as I say, we've got an asset that's in our balance sheet valued at £14,000, but we sold it for £28,000, meaning that we've got a profit of £14,000. I'll do loads of these questions for you when I see you next. So on Thursday we'll go through some more, and on Friday I'll do a lot more of those questions as well. Okay. For this one, what I did when I was doing it this morning is this is a credit customer has returned goods which cost £4,500 including VAT at 20%. So the customers returned the goods. So what I did this morning when I was playing around with it, let's make it smaller. I started off by doing what the original sale was. This is called our trade receivables or our sales ledger control account. So back to Pearls. These are customers that have bought goods from us. So what I did this morning when I was doing it, I'll rub these out. If I put in the original transactions, so the original transactions for the original purchase, so we sold goods to our customer for £4,500. Okay? So that's what we sold them for. Whenever we've got a calculation that says inclusive of VAT, we divide it by 6 for the simple reason, what I've done down here, is the 4,500 equates to 120%. Yeah, because it's like when you get paid, you get your net, which is here, then you get your tax, and then you get your gross amount. So that 120% is what 4,500 equates to. So what we do is we divide it by 6 to get what the VAT is, which is 750. So 20 divided by 120 is 750. But again, simple way of doing it, and again, this is in the exam. So when you get the question including VAT, divide it by 6, which gives us £750 for the VAT was 750 and the sale was 3750. So when they recorded the original sale, they said, okay, so we debit the trade receivables for 4,500, so the owe was £4,500. We credit sales for 3750, the net. We also credit VAT for 750. But this is a return. So what we do for the return is we basically just do the opposite. So this 4,500 is, we're going to credit that to get rid of it. Okay, so that's gone. We're going to debit the VAT to get rid of that, so it didn't exist, which is 750. And what we don't do is we don't ever sort of like just debit sales. So we don't put the figure in here. We create a new account called sales returns. Okay, so we know how many returns we've got over this period of time. So that 3750, we're going to debit sales returns. So the answer to this question is, so we're going to credit sales ledger control account, which is this bit here. See? So we're going to credit sales ledger control account. We're going to debit VAT, and we're going to debit the sales returns. That's a debit sales return. Okay? So again, we'll go through that one in class again. I'll do a few more questions. I've written quite a few papers, so I've got quite a few samples for us to go through. So by the time it comes to the exam, you'll be in you'll have a good understanding of what you need to do. For question 9, when we did it in class, we said, so a company, again, so an accounting equation question. So a company's got assets of 75,000, so assets of 75,000, and equity of 120,500, and we're trying to find out what the liabilities is. So what I did when I was doing this the other day, this morning, you can rewrite the accounting equation. So if you move the assets over to the other side, it becomes a minus. So therefore we've got liabilities equals assets. Now it's going to be, capital. Start again. It's going to be capital, but this time it's going to be a minus for your assets. So we know what our current assets are. We know what our capital is, 120,500. We know what our assets are, 78,000. So therefore, as a process of elimination, the capital, which is the figure we're after, is 42,500. So that's the answer to that question. That one's not in the exam, so you don't need to worry about it too much. It's a straightforward accounting equation question. The next thing, as I said before, is the debts which are repaid within a short period. So these are liabilities, but they are short-term liabilities. Things like overdraft or trade payables, so money you owe to your suppliers, or it's usually VAT. And again, they're what we call current liabilities. So short-term debts, if you like. Okay, so current liabilities. Question 11 is also an accounting equation question, but this time it said David, so calculate David's opening capital, this figure, given the following assets and liabilities. So again, accounting equation, so assets minus liabilities equals capital. So we're recording our assets. So non-current assets are things like buildings, motor vehicles, fixtures and fittings, computers, those things we buy for the long term. That's 60,000. We've then got inventory of stock. This is a current asset, the inventory. So we've got inventory of 10,000. We've also got bank balance, which is also a current asset. So therefore that is 5,000. So we've got total assets of 75,000. It then says we've got a loan from his father of £8,000, which is a liability because now he owes his father. That'd be nice, wouldn't it? It'd be nice if he gave it to you though, wouldn't it? So we've got a loan of 8,000. So a loan of 8,000. Excuse me. And then it also says that he took out a bank loan to pay for the non-current assets of 20,000. So he got a loan for 20,000. So therefore his total liabilities are 28. So now we know his current assets, his assets minus his liabilities equals his capital. So his answer to that one is 47,000. As I just said a minute ago, so cash and other resources that are expected to turn into cash or be used within 1 year of the balance sheet. Key thing is cash and other resources. These are assets. Cash is like bank or bank and cash. And are expected to be used up within the year are called current assets because it's a short-term asset. It never stays the same because your inventory in the year never stays the same, neither does your bank because it changes, goes up and it goes down. So we call those current assets. Nearly there. Number 13 is a sales ledger control account question. And what I did when I was discussing it with you earlier today is this bit here. In fact, I'll rub this bit out just to remind you. So a sales ledger control account, I don't rub it, I'll leave it. So a sales ledger control account, otherwise known as trade receivables, is your control account for all of your debtors. So what I did this morning, if you started off, let's say as an example here, let's do it here. So let's say, for instance, you started off at the beginning of the month, so on the 1st of January, the balance brought down on the debit side was £10,000. That means that your customers owe you £10,000. So this is what we call the control account. So this £10,000 would then be split between all of our customers. So like customer 1, as an example, we'll have a figure here. Customer 2, so customer 2 will have a figure here. And all of these figures will add up to this total amount, which is called, so that's your total amount of money that's owed by your customers. So they owe us £10,000. And the question that I asked you in class is, so what would increase the amount of money that our customers owe us? So what will increase the amount of money that our customers owe us? And what we said is more sales. So more credit sales will increase the amount of money that our customers owe us. What would reduce it would be bank, so bank payments received. So when we receive money from our customers, it will reduce the amount of money that they owe us, okay? Any discounts that we give them, so discounts allowed, that will also reduce the amount of money that they owe us. And this one, what we call contra, it's this contra to supplier. It basically just means, so we have sales ledger control account, and we also have a purchase ledger control account that records all of our purchases that we've made on credit. So all this boils down to is that it's where the supplier does business with the customer. So for example, I was sort of saying this morning that if I did business, say with Gemma, excuse me, and I sold her £1,000 worth of goods, but she also buys goods from me and she owes me £1,000. So rather than me go, there's your £1,000, Gemma, she goes, oh, and there's yours, give it back. We adjust it through the accounts. So this is the contra entry from the supplier. So this is called the contra. They actually put PLCA. So this is from the purchase ledger control account because it reduces the amount of money that we're owed. So this question was where we had to complete it because it said it contains numerous errors. So that figure was right. In fact, I'll rub this out so we can see. That figure was right. So in other words, the balance brought forward says that we're owed 41,500, which again, I've put down here. So that one's fine. Payments received, that's on the wrong side because that's money that's been received by our customers. So therefore, that should be on the credit side, okay? Credit sales, so again, we said over here, so what will increase the amount of money our customers owe us? So therefore, credit sales will go on the debit side. And then what reduces it, we said before, so discounts allowed should be on that side. That should be on that side. So the discount, because it reduces the amount of money that we're owed. Well, that one's right, because that's the contra entries, they call it, from the supplier. Okay, so therefore what we do is we put the 500 on the credit side as well. And then what we do is we need to balance it up to work out how much money is owed. So look at the side with the greatest amount, which is clearly this side, because we've got 41,032. So we add it up, which gives us 73,755. We take it across without thinking, as they say, which is 73755. And then what we do is we say, so how much money, or what figure should I say, needs to go in here to make it balance. So what we do is we add all these together, so that and that, and we take it from here. So this bit here, if you like, is what we call the balancing figure. Yeah, so now I add all these together and it will equal this. So that's called the balance carried down, and then we bring it down to the next month. All it basically means is at the end of the month, our customers still owe us £36,390. So £36,390 is the right answer to that question. Again, we'll do that in much more detail when we do it next week. So 36,390. Now let's do this one as well. In fact, I'll rub it out. It's because it's just along the lines of what we just said. So let's rub it out and do it from scratch. So in light of what we've just said above, so this is our sales ledger control account, or trades receivables. And this is our credit sales. So the amount of money that we're owed at the beginning is £125,000. So we're owed £125,000 from our customers. We've then got bank, which is bank receipts. So this is money that we've received from our customers. So again, this will reduce the amount of money that they owe us. So that goes on the credit side, 112,500. Sales returns. So again, sales returns will reduce the amount of money that we're owed. So that goes on this side. So 1250. And then we've got bad debts. Okay, so bad debts is also going to reduce the amount of money that our customers owe us. Okay, so because we've got a bad debt, that also goes on this side, which is 1,500. Okay, and then we've got a returned unpaid cheque. So this is where the customer paid us, so therefore it would have gone into the bank, but it's been returned, so therefore it needs to go back. I'm going to put that figure back in here of return cheques, which is there. So return cheque is 1750 because it's been returned, and the contra entry for the purchase ledger control account is 2,000 again because it reduces the amount. I didn't have time to finish it this morning, but I'll go through it with you now. So again, as we said before, when it comes to balance it up, I just get my calculator, so quite clear. The one on the greatest side is, which side do you think? It's probably this side. So I'm going to go 125,000 plus 1750 gives us 125,170. I'm going to take it across without thinking, so 125,170. And now I need to work out, so what figure is going to go in here. This is called the balance carried down. Okay, so I'm going to go 125,170 minus 2,000 minus 1,500 minus 1,250 minus 1,500 is 7,920. So our balance carried down is 7,920. In others, all these added together plus that equals that. Okay, so that means that our customers owe us £7,920. Let's say, for instance, these were May transactions. Not that you have to know this now, but that can't be right because it's not in that question there, so I've got something wrong there. I must have added it up wrong. 125, that's not, that's where it's gone wrong, isn't it? Don't be me. So 125,123 plus 1750 is 126,750. See, don't be me. I know you would have spotted that. 126,750. 126,750. So minus 112,500 minus 1,250 minus 1,500 minus 2,000 equals. Am I being really dopey here? Let's have a look. 112,500 plus 1,250 plus 1,500 plus 2,000 equals 117,250 minus 126,750. It's 9,500. It's me not adding up properly. So the balancing figure is 9,500. Okay, so again, all of these added together plus that equals 9,500. And then what we do at the start of the next month is balance brought down, and we start all over again then, 9,500. So it basically means that our customers owe us 9,500. Again, the answer to that one is that one. Again, I've got loads of these questions that we're going to go through in class, but I have to stress the importance of being in class because then we can go through it. Okay, so that's number 14. Number 15, it said, which of the following is not an asset? So you know from experience that an asset is something that we own. So a building is something that we own, so that is an asset. Computer and motor vehicle are assets, but loan to buy equipment is we loan, so we know that's a liability. So the answer to that one is C. So is a liability. The next one is what we call the matching principle. And the important thing about accounting is we've got, let's say we've got the 1st of the 1st. So our financial year is the 1st of January until the 31st of December. So this is our financial year. And what we need to do, we need to match our income against our expenditure. So we need to know what we've spent in that particular year and what money we've received, so we can work out what our profits are going to be, what our taxes are going to be, so on and so forth. So that's called the matching principle, where we need to match our, what's it said here, the principle that all expenses incurred while earning revenues should be identified with the revenues when they're earned are reported for the same time period is known as the matching principle. So we're matching things, matching income and expenditure. The other thing we've got, question 17, is what we call the accrual basis of accounting. So the accrual basis of accounting records, so records revenues when they are. So the example that I used again, so let's say the 1st of January, so the first of the 1st to the 31st of the 12th. So that's our accounting year. But let's say, for instance, in November, I sold £10,000 worth of goods to one of my customers. So the sale took place in this year, but let's say that I sold it in November, but I don't receive the money until January or February. So after our year end. So the important thing is that we need to make sure the accrual concept says that we record our revenues when they are earned, not when it's being collected. Okay, so that's the key thing, because again, it's not the same thing. So when you sell goods to your customers, or you buy goods from your suppliers, so I might make £5,000 worth of purchases here, but I'm not going to pay for it until out of there. So you need to make sure, as I said before about the matching concept, the purchases took place here, not there. They were paid for there. So cash sales and purchases, it has a big impact. So we need to make sure that we recognise them. So we recognise them when they are earned. Okay. Now this is number 18. So number 18 said the core objective of accounting is that one there. The core objective of accounting is to provide financial information for the users of information. So we said before that financial accounting was about producing the financial accounts for external users, such as creditors, investors, or who else, or investors or lenders or something. So therefore, as I said, the core of accounting is to provide information for external users. So it's C. Number 19. So why is an expense for depreciation included in the financial statements? And I said to you before in that question that we looked at, where we were looking at that asset that was £34,000 with a £2,000 residual value. It had £20,000, I think, was the depreciation overall. So depreciation is what we call, it's a charge to the wear and tear. So it's a charge for wear and tear. It's the reducing the value of the assets because of wear and tear. So the answer to that one, he says, the answer to that one is C. Sorry, is A. That would be me. And then finally, again, another important question for the exam. So this one said a company incurred the following expenditures on a motor van. So in year one, we bought a van for £80,000. In year two, we purchased some tyres for £2,000. In year three, we purchased a trailer for the van, and that cost £10,000. We have something that we call capital expenditure, and they're the things that we buy for the long term. So capital expenditure is money we spend on our fixed assets, such as the computers or the tables and chairs or a motor vehicle, things like that, or buildings. They're what we call the non-current assets or fixed assets we buy for the long term. Okay. We also have what we call revenue expenditure. So revenue expenditure is things like your day-to-day running of things. So I've said before that, let's say in our premises, we built an extension on the side of the building. That will be an extension of capital expenditure because we're making improvements to the building. Whereas if we're decorating it or just put some carpet in, it's not really a capital item as such. It's more revenue expenditure. But it's like in the shop. In the shop, if I buy a new van for the shop, that's an example of capital expenditure. But revenue expenditure are the things like the stock and buying, the heat and lights, all of the expenses that are used to keep things ticking over. Again, similar in the exam. Purchase of new tyres is an example. So purchase of new tyres is an example of revenue expenditure. It's not capital item tyres. Okay, so therefore, forgive the cough. I've got some water. So on that basis, it depreciation on all vehicles is 20% at cost. Okay, 20% on the cost price. So the full year's depreciation is charged in the year of purchase. What is the depreciation charge for the vehicles in year 2? So with this one, all we do is 20% of the cost. So the cost is 80,000. Depreciation is at 20%. So therefore, the depreciation charge is £16,000. So every year, for those, well, till the vehicle becomes no good, I suppose, is we depreciate it at 20%. The depreciation charge goes in the profit loss account as an expense for every year. So therefore, the depreciation charge is £16,000. Phineas is asking me a question. Well, it's year 2, so it's 2 years depreciation. But the depreciation charge is always the year. How it works in accounting terms, depreciation is an expense. So for this example, we'd go for year 1, we would go debit depreciation, £16,000. And this is called accumulated depreciation. This goes in the balance sheet, and that would also be 16,000. So you got your debit in your depreciation account and credit in your cumulative depreciation. Okay, that's year 1. For year 2, still 16,000. Extra note, sorry. So the depreciation charge to your P&L, to your profit loss account, is 16, and you would also credit your cumulative depreciation as well for 16. Yeah, but this time that's £32,000 worth of depreciation. Yeah, so let's say the asset as an example. So how much did it cost us? So it cost us £80,000. So £80,000 is the cost of the asset. So that's the cost. The depreciation for the first year is 16,000, which therefore gives us what we call the net book value of the asset. What's that, of 64,000? Yeah, 64, 74, 80. So that cost minus depreciation means the value of the asset is 74,000 at the end of year 1. In year 2, the cost is still 80,000 because it's on cost. Depreciation charge is still 16,000. Yeah, in fact, no, I'll change that because the value of the asset at that point is 74,000, isn't it? So 74,000. So therefore, we take off 16,000 again, and that would reduce it by 16. Just out of interest, I should know it, but I'll do it anyway. I'm just showing you how it works in the accounts. So we had 74,000 minus 16,000, 58,000. Okay, but the depreciation charge is the same in the profit and loss account each year. So year 3, year 4 and year 5, and that just gets added up as we're going along as far as your cumulative depreciation is concerned. All you're doing is just adding 16,000 each time. So after year 3, so that will be 48,000. So it's reducing the value of the asset all of the time. Okay, so again, just as an example, but we're still on cost. So the cost of the asset was 80,000. At the end of year 1, 2, say year 3, so year 3 will be £48,000 worth of depreciation, which means at the end of year 3, the asset will be worth 32,000. Yep, so that's year 3. Year 4, 16,000 again, we'll take it to 16, and then you can see after 5 years the asset's gone. Okay, so we'll do that again when it comes to practice, practice, practice. Any questions you've got or any issues you've got, we'll address them next week. I did say on Thursday, after Charlotte's tutorial, I'm going to dive into the Zoom class and I'm going to take you through any questions you've got from this. And then on Friday, we're going to do another one. So I'm printing off another paper. These are very similar. I wouldn't be going through them if they weren't important. So it's important for you to work through them and come back to me and ask me if you've got any questions. I did say to Roxana on Friday that next Friday afternoon at 1 o'clock or 1:45, if you want to stay behind, we'll go through any specific questions or problems that you've got. Okay? So good luck. Practice, practice, practice. Any questions?